Hello, I'm Raymond Monroe. This is our podcast, Rambling with Raymond, and we're following up on our last podcast on capital equipment investment by talking more about the financial structure of steel foundries, how much they're worth, how do you evaluate your productivity and profitability, how's a captive operation operate. And I'm joined really by good friends Ed Kejmerek and Peter Mackler, who've been my companions for the podcast so far. And we're joined by George Harte, retired from Falk Corporation, as someone who ran a captive foundry and was really an outstanding foundryman. So I hope you enjoy the podcast today. Let me start out by sharing my screen. This one is really pretty straightforward. This is the sales divided by total assets, which is, you can actually see this in any of the big macroeconomic stuff. You can do general revenues divided by book value, however you want to do it. And you end up finding the same thing, that the typical value of an organization is half of the total sales. And I've always attributed that to the fact that you really, from an ownership standpoint, you want your return on investment to be about twice the return on sales. But you can't do better than that. But if you can get a higher gross margin, then you can have a higher sales per total assets. And if you're not as good, you can be down almost at one, where you're really only making your return on sales. So the next slide is the profit before taxes divided by total assets. And you can see what I was saying. People were 5 to 10%, whereas on this one, you're between 2.5 and 1.5%. So you can see that 2-to-1 kind of ratio. And so the profit before taxes, you can be as high as 15 and as low as minus. And so, Peter, you had mentioned that EBITDA is your measure, and I couldn't find any way to get EBITDA. The closest I could get was profit before taxes. And that didn't seem to be very good. And this actually shows that all of the different manufacturing folks are really in a pretty narrow band when it comes to profit before taxes. I did do gross profits. The machine shops make more gross profit than us, but then after they get through paying everything else, they're down right in the middle where we are in terms of profitability. And I wondered if this profit before taxes divided by total assets might give you the same kind of span. This is the top 75%. This is the bottom 25% in these two graphs. So
Are these just foundries or all manufacturing?
these are just steel foundries. This isn't foundries in general. This is steel foundries. These two graphs are just steel foundries. And this is from the Risk Management Association. And the Risk Management Association really are all of the private banks who give a line of credit to private industry, get pro forma audited statements to know how healthy the corporation is, and to be able to assess whether or not that corporation is typical, better than, or not as good as other people in their same business. Everybody gives all of those pro forma audited firms to the Risk Management Association, which, Peter, you would appreciate, used to be the Robert Morris folks. Yep. And wherever they get an aggregated amount of data, they separate it out by the total volume of sales. And so this is really steel foundries for foundries that are $10 million to $25 million a year. So these are not the great big ones because there's not enough of them to create something that you can do. It seems to me that was something that I always would tell people that, and I think I mentioned it last time, that if you want to know how much a foundry is roughly worth, it's half of their total sales revenue. But you had, Peter, talked about EBITDA and said you were going to see if you could find some. You'd given a range. It seemed like 12 was a really good number and 6 was a really bad number, but I may not remember that correctly.
Actually, it was a study that was in Foundry magazine years ago, and okay. 6 was the average
Okay.
6 times EBITDA would be the sale price of the business. And I did find today for steel and iron manufacturing, which of course included steel mills,
Sure.
it was around 4. So, and that doesn't surprise me because the steel mills probably operate in a narrower margin because of the competition. So it doesn't surprise me that it might be slightly lower. And so I think the 6 probably isn't far off from a fact right now. I just wish I could get that Foundry magazine article. I couldn't access it online, but so I think that's a good number. And I've assessed quite a few foundries that buyers and sellers wanted to get involved with, and I assessed it on their behalf. And also for banks who were loaning money, I've done assessments, and I've used the EBITDA rule with all of them, and no one ever shook their head. We don't like that. So I think it's a decent measure.
Well, I haven't dealt with all that many foundries or businesses where I could say I had a large personal database to be able to come up with a number.
Mhm.
I have talked about this with my venture capital private equity buddies. I went into the wrong business. And the
You went to the
numbers,
dark side.
yeah, the numbers that Peter's talking about are right in what they're saying.
Okay. That's interesting because I mean, yeah, you said you made the wrong decision. Just think about poor George working for a captive organization all of his life, because captive organizations, in my understanding, always misunderstand having a captive foundry. And they take the overhead and divide it by the labor content as a sort of historical artifact. But the foundry only gets the transfer cost for and so their transfer cost can be really high, and it doesn't mean anything because they're carrying the corner office and they're getting almost no value out of it. But what are some of the challenges you face, George, being a captive foundry?
One of the things was our tonnage it varied from time to time, but say it was 50-50 split contract castings versus what we made for in-house. So, and everything that was transferred in-house, there was no markup. It was transferred at our cost.
Sure.
So we got no benefit to making those parts from an income standpoint.
Yeah, well, and you got hurt by that too, because business was really fast and you were booked fully and they needed something fast. You couldn't charge a high markup because of their screw up. You just got the transfer cost.
When our coupling facility in Auburn would screw up and not have enough inventory to meet the market demand, we would work Saturdays and Sundays to make sure that they had product out in their yard so they could meet their customer demand. But we never got any credit for that. Yeah. We got paid up for it. But what they would, I was under 3 different ownership. The first one was Sunstrand, and then United Technologies, and then private equity. It wasn't so much with Sunstrand because there was some management people from Falk that went to work there. But after that, they would look at our sales dollars, which our tons, we were totally profitable. We made all this, and this is all we got.
Wow.
But they didn't understand anything.
Yeah, one of the challenges has always been, I remember talking to Ken Murphy and to you and other people in captive operations, you always had to keep sort of an internal private set of metrics showing that you were as efficient as anybody in terms of scrap, labor efficiency, those kinds of metrics, so that you could demonstrate that no, the foundry wasn't in bad shape. It was just an artifact of the corporate accounting system.
Yes.
And how well did that work?
It worked well till 2001, when Sunstrand was acquired by UTC. And then it was bring in the bean counters and we're going to make everybody the same ROI as an aerospace company, including a steel foundry.
Wow.
So
Peter,
it got interesting.
Peter, you've obviously worked with captive foundries. What's the difference in your business dealings with captive foundries compared to privately held operations?
Well, they have a different mission, and their mission is to make sure the parent company gets what they need when they need it. And
Right.
that may not mean that the foundry can operate at optimal performance. They may have to compromise to get it done. So it's difficult to compare them. I would say in general, a captive foundry is not running at the same efficiency as the competitive independent foundries. Not because they don't want to do it, it's that their mission is a bit different. So
we might have been a little bit different because after the big blow up in the early 80s, our livelihoods were threatened on a regular basis. So we were a typical jobbing foundry. We were running 55 to 60 man hours a ton, which was typical for the industry. We whittled that down to the high 20s, low 30s. So from that standpoint, I think we were extremely efficient.
Yeah, one of the interesting things, Peter, is that when we've done internal sorts of studies, most of what you said is correct. And so you had people like SIPCO, that the only reason they kept the steel foundry operating, they were actually using their AOD to make the molds for the ductile iron pipe. And there were other people, but like Newport News through the 80s and 90s became really a shadow of itself. It wasn't very efficient at all. But George always was way up there in efficiency. So he was in really good shape when it came to comparing their internal efficiencies and quality levels. But that was really a leadership issue more than a corporate organizational issue. As you know, leadership is what really gives you that wide range between people who are performing really high and people who are either mediocre or going out of business.
Well, I have worked with companies, and Reliance Electric, of course, they had a shop in South Bend, and in that area, which was very well run. The manager of the foundry was superb. And I think that was a bit the exception to the rule. They were a captive foundry, but they were very, very efficient and very respectable foundry. And I've been with others, pump companies, won't mention names, where they had foundries. Not so much. They were tied, just the pace was make sure you meet the needs of the parent corporation. So I appreciate there can be exceptions to that.
Yeah.
For purposes of this discussion, I think the assumption is that a captive foundry is one that's providing parts to another, call it parent entity,
Right.
as differentiated from not a privately owned company, but one that's part of a conglomerate.
Yes. That's a good point.
Which may have another whole third set of financial objectives.
Well, you worked in a very different environment, a multi-plant foundry organization when you were with Grady, and that's a different model also, because then you've got to be competitive with the other foundries, iron and such. And you were in the steel foundry. What was different from running a steel foundry from the iron foundries at Grady?
Well, in that particular case, a couple of things besides the obvious. There was only one steel foundry, and there were more than 10 iron foundries. One of the differences was that the steel foundry was one of the oldest.
Right.
And so there were a lot of legacy costs associated with that were a much lesser factor. The way Grady allocated costs and just the out and out real costs were different in that regard than the iron. The iron foundries were much more heavily focused on equipment costs and all the various ways that flows through the accounting system. Whereas steel foundry tended to have really low, because it's older than the hills, equipment cost, but really high labor costs.
Yeah, I remember observing that, and I think you told me this, that none of the iron foundries had any equipment that was older than 20 years old, and you didn't have any pieces of equipment that were younger than 20 years old. And people still talk about the new furnace that was installed in 1978.
Right. And so sometimes accounting systems struggle to be able to, I don't know that fair is the right word, but when you have one universal system that everybody's operating under, sometimes the real outliers can tend to skew those evaluations, or what is in fact a fair cost structure.
Yeah. Thanks for watching the podcast. I hope you enjoyed it. It certainly seemed to me to be useful and interesting. I wondered if you had any particular topics you'd like us to explore in a future podcast. I thought maybe we need to really explore labor productivity and how productive we are in terms of financial as well as in human effort in terms of the steel casting industry. But there are other things that people might be interested in. So if you enjoyed this podcast, please let me know. And if you have other topics you'd like us to discuss or other people you'd like me to interview, please let me know. I hope you enjoyed it, and I hope this was helpful to you in some ways. Thank you.